Hello everyone, I'm Sarah Liasiri, a financial markets analyst at CFI, and today we're going to discuss the only tools that you will need to trade successfully. So basically today we're going to discuss fundamental analysis, we're going to discuss technical analysis, and we're going to discuss the most important aspect in the financial markets, which is risk management, and lastly, we're going to discuss the emotions and how to avoid them. So basically, first of all, we're going to discuss the roadmap. The roadmap is technical analysis, fundamental analysis, risk management, and emotions. So basically, technical analysis is studying the path price movement in order to forecast future price movement. These can be under, for example, by analyzing trends, technical indicators, or technical patterns. While fundamental analysis is studying or analyzing the factors that can have a direct impact on the market, whether quantitative factors or qualitative factors. So basically, for example, it's an analysis, for example, for the economic situation, the geopolitical tensions, or anything that can have a direct impact on the market. It comes under fundamental analysis. And we're going to discuss the risk management, which is considered the most important aspect in the financial markets. And lastly, we're going to discuss the emotions and how to avoid fear and greed, for example, how psychology affects our decisions. So basically, we're going to start by discussing the types of analysis. So we have two types of analysis, fundamental analysis and technical analysis. Fundamental analysis, as I just mentioned, it's analyzing any factor that can have a direct impact on the market, whether economical factor, geopolitical factors, or any indicator, for example, any news that can have a direct impact on the market. It comes under fundamental analysis. While technical analysis, it's studying the past price movement in order to forecast future price movement by analyzing the trends, by analyzing technical patterns or technical indicators. We're going to discuss this in more details. So basically, we're going to start by discussing the objectives of fundamental analysis. We have short-term approach and long-term approach. Short-term approach, for example, it's the releases of the economic indicators, whether retail sales, CPI, crude oil inventories, or GDP. So basically, when a certain or a specific indicator, there's a release for a specific indicators, we analyze the effect of this indicator. For example, if we have the GDP, for example, today the GDP reading will be released. So basically, we do an analysis for the expected reading. We compare it to the previous reading. So basically, it's a short-term approach. While long-term approach is combining many indicators in order to forecast, for example, the future monetary policy. It's, for example, to forecast interest rate decisions. So basically, long-term approach, it combines the analysis of many indicators in order to forecast the future path, for example, of the monetary policy, of the yield curve, for example, for the economic health as a whole. Now we're going to discuss the objectives of fundamental analysis to the companies. So basically, same as Forex, we have short-term approach and long-term approach. Short-term approach, it's by, for example, analyzing the financial statements or financial ratios on a quarterly basis, for example, analyzing the net income, for example, for a quarterly basis. The earnings, for example, you can do an analysis for example, 1 quarter or 2 quarters. So basically, these all comes under short-term approach. While long-term approach, it's, for example, analyzing the industry as a whole. For example, if I want to invest in the technology sector or the financial sector, so basically, I do an analysis for the industry as a whole. First of all, I do an analysis for the whole sector for the corporate ratios, for example, for the past 5 years in order to forecast the future path of the stock. And lastly, the long-term approach, it's by analyzing, for example, the dividend distribution, mergers and acquisitions, and many more. Now we're going to discuss one of the most important topics, which is the US dollar. Why the US dollar is considered the strongest currency in the world. We all know that the US dollar is the most traded currency in the financial markets. 80% of the trading in the global currencies are by the US dollar. And secondly, it is the global reserve currencies, and it is held by central banks and governments around the world as a cash reserve. The US economy is the largest and the most stable economy in the world, and we all know that the United States is the world's only military superpower and has a stable political system. The last thing, most of the world's commodities are priced in US dollar. For example, gold, silver, oil, for example. All of these are priced in the US dollar, which is considered a very important aspect. So basically, we have to know the path of the US dollar in order to know the path of the rest of the financial instruments, for example, euro, pound, US oil, for example, oil, gold and silver, and many other financial instruments. So it's very important to know the path of the US dollar. As we just mentioned, it is the most traded currency in the world, and it's yes, 80% of all the trading the global currencies are the US dollar. Now we're going to discuss the most important factors that affect gold prices. It's very important to know the factors that affect the financial instruments that you trade in. For example, if I trade in gold, for example, oil, euro, it's very important to know the factors that affect the prices. For example, we're going to start by discussing the factors that affect gold prices. First of all, economic uncertainty. When there is uncertainty in the economy, gold prices tend to rise. When there is high interest rates and high inflation rates, gold prices usually tend to decline. The US dollar, when there's a rise in the US dollar, it is expected to negatively affect gold prices, and prices is expected to decline when we have a strong US dollar. Geopolitical tensions can have a positive impact on prices. When there's a geopolitical tensions, this can affect gold prices in a positive way, and bond returns. When there is a high bond returns, this can negatively affect gold prices. Now we're going to discuss the most important factors that affects oil prices. When there is economic growth, it means that we have a demand. High demand means that prices is expected to rise, and vice versa. When there is a recession, for example, there is the demand declines, and basically the prices starts to decline. When there's a geopolitical tensions, this can have a positive impact on oil prices, and the US dollar, when there's a strong US dollar, this can negatively affect oil prices, and OPEC decisions regarding the productions can also have a direct impact on the prices. And lastly, the crude oil inventories, which gives us an indication about the supply and demand, and this can also have a direct impact on the prices. Now we're going to discuss the most important factors that affect the stock prices. For example, as we just mentioned, the corporate results can have a direct impact on the prices. When there's, for example, a positive news or a strong corporate result, this can positively affect the prices. When there's high interest rates, this can negatively affect the prices. And the cash dividends is so important. For example, try to look for companies that distribute cash dividends, as this is considered a strong and a positive indication and you have to also do an analysis for the whole sector. For example, if you want to, for example, to invest in the technology sector, the financial sector, it's very important to do an analysis for the performance of the sector as a whole. And lastly, the economic growth and activity can have a positive impact on the prices, while a recession can have a negative impact on stock prices. Now we're going to discuss the economic calendar. The economic calendar is considered a very important thing in the financial markets. For example, we have an indicators that can have a high impact on the market, or medium impact, or a low impact. It's very important to know or to do an analysis for the indicators that are going to affect the US dollar, as we just mentioned, because you will know the path of the gold, of the euro, of the US oil, silver. So basically, it's very important to look for the indicators that's going to affect the US dollar and also going to have a high impact on the market. For example, a CPI, interest rate, unemployment rate, non-farm payrolls. So basically here, we have three readings. We have a previous reading, a forecast. You have to compare the forecast with the previous reading to know how it's going to affect the US dollar, for example, or the euro or the pound. So basically, first of all, you look for the expected reading, you compare it to the previous one, then it's going to be easier for you to forecast the effect of the actual reading on the prices. For example, here, the reading was higher than the expectations and higher than the previous one. So it is expected to have a positive impact on the US dollar. Now we're going to discuss the speeches, for example, of the Federal Reserve. We all know that these speeches can have a direct impact on the market, as we do an analysis for the tone in order to expect the future movement, the future monetary policy, the future decisions regarding interest rate. So basically, it's very important to follow the speeches in order to try to know what is the path or what is the next step for the central banks. So now we're going to discuss briefly the technical analysis. So as I just mentioned, technical analysis is studying the path price movement in order to expect or to forecast the future price movement. These can be by analyzing the trends, analyzing technical patterns, or technical indicators. So basically, when you open any chart, here you will see the period. For example, we have monthly time frame, weekly time frame, daily time frame, 4 hours, 1 hour, and 30 to 1 minute time frame. So basically here, you will see the period, you will see the symbol. For example, here it's Euro USD. Here on the right, you will see the prices, and here you will see the time. Now we're going to discuss the types of charts. So basically, we have three types of charts, which is line chart, bar chart, candlestick chart. Line chart, it records only the closing prices, while bar chart gives us the highest price, lowest price, open price, and the close price, while the candlestick chart can gives us also the highest price, lowest open price, and close price. But here we have, for example, patterns, candle patterns. For example, we have reversal, continuation. We're going to discuss them now in more details. So the Japanese candlesticks, here we have red and green. These can be white or black. So basically, these are the most common in the financial markets, which is the green and the red. What is the difference between the bullish and the bearish? Why here we have a red candle and here we have, for example, a green candle? So basically here, it's the upper shadow is the highest price during the period. The lowest price and here it's going to be the highest price and the lowest price. The main difference is the opening price and the closing price. Here, as you can see, the prices opened at 150 and closed at 100. So basically, as you can see here, the closing price is lower than the opening price. So here we have a negative candle, a bear candle, or red or black candle. On the other hand, here, the open price was 100 and the closing price was 150. So as you can see, the closing price is higher than the opening price. So basically here we have a bullish candle or green candle or white candle. So the main difference is the opening price and the closing price. The upper and lower shadows are the same. So we're not going to discuss in details today the candlestick patterns, but I just want to let you know that we have candlesticks patterns that it can be either single, double, triple. So basically, these candles can give us an indication that the previous trend will reverse or is expected to reverse, or the previous trend is expected to continue. So basically, we have a reversal patterns and we have a continuation patterns. We have single patterns, double and triple. We're going to discuss the candlesticks patterns in other webinar, but it's important to know what are the candlestick patterns, what is the importance of candlestick patterns, as I just mentioned. There's a reversal and there's a continuation. So this is a very important thing to know. Now we're going to discuss the support and resistance, and we're going to discuss the trend line. So basically a support, as you can see, it's a level. Whenever the prices touches a support levels, the prices tends to go upward. For example, here, the prices touched support levels and the prices increase, okay? Here we have another touch in the support levels. So basically, this is a support levels, and you can see we have an increase in the prices. And here it's the third touch. So basically, the support level is a demand level. Here we have a very high demand that overcome the supply. So basically, whenever the prices touches the support level again, it is expected that the prices will rise. So basically, we start to buy near a support level and vice versa. For example, here it's a resistance levels. Whenever the prices touches a resistance levels, the prices decline. Here we have a second touch, and as you can see, the prices decline. So basically, try to look for levels that whenever the prices touches this levels, the prices decline, or whenever the prices touches a certain level, the prices rise. So basically, you need 2 points or 2 peaks in order to consider this a resistance levels. And here you need 2 lows or 2 touches in order to consider this a support level. So basically here, whenever the prices exceeded as a resistance levels, here you can start to buy, and basically when there's a stability above a resistance level here, you start to buy, and whenever the prices breaks a support level, you start to sell. Now we're gonna discuss the trend lines. So basically we have 3 types of trends: upward trend, downward trend, and horizontal trend. What do we mean by upward trend? It's, as you can see, it consists of higher highs and higher lows. So basically, you need 2 highs and 2 lows in order to consider that this is a trend, and you need a third high in order to confirm the upward trend. So basically, the upward trend is higher highs and higher lows. Don't sell in the upward trend. Whenever the prices decline in an upward trend, here you start to buy. Don't sell in an upward trend, or it's not recommended to sell in an upward trend. The downward trend is completely the opposite. It consists of lower lows and lower highs. So basically, don't buy or it's not recommended to buy in a downward trend. So basically, whenever the prices rises in a downward trend, here you start, or it is recommended to start to sell. Don't buy in a downward trend. The horizontal trend is equal highs and equal lows. So basically, it's not here, but it's equal highs and equal lows. How to trade the trends? So basically here, whenever the prices touches an upward trend here, it is recommended to start to buy, as it is expected that the prices will rise and vice versa. The downward trend, whenever the prices touches a downward trend, it is expected that the prices will decline. So basically, in the upward trend, try to look for buying position, and the downward trend, try to look for selling positions. Now we're going to discuss a strategy which is called a bear trap and a bull trap. Try to use this strategy on a demo account, then try to use it on your real account. But first of all, test the strategy. It is recommended to test the strategy on your demo account. So basically, what do you mean by bear trap, or what do you mean by bull trap? The bear trap, as you can see, here we have an upward trend. The prices broke the upward trend. So basically here we're going to start to sell. As you can see, the prices rebounded again and exceeded the last high before the breakout. So basically here, first of all, we have an upward trend. The prices broke the upward trend. The prices rebounded again and exceeded the last highs, or the last peak above the support area. And as you can see, the prices achieved stability above the last peak. So basically, it is recommended to close your selling position and to start to look for buying position, as this is considered a bear trap. So basically, I'm going to repeat it again just to confirm. Here, for example, we have an upward trend. The prices broke the upward trend, and then the prices returned and exceeded the last peak, or the last high above the support area, and the prices achieved stability above the last peak. So basically, it is recommended to start looking for buying positions. The bull trap is completely the opposite. So basically here we have a resistance level at 3.3. The prices exceeded the resistance level, and then the prices return, and as you can see, it broke the last low before the breakout. So basically, this is considered a bull trap, and it is recommended to close your buying position and to start looking for selling position. So basically, we need to have a resistance area or a resistance levels. The prices, as you can see here, exceeded the resistance level, first of all. Then the prices returned, and as you can see, it broke the last low before the breakout and achieved stability below this level. So basically, this is considered a bull trap, and it is recommended to try to look for selling position. Test the strategy on your demo account. Then if it's helpful, you can start applying it on your real account. So basically now we're gonna discuss the psychology and risk management aspect. It's very important to try to avoid these emotions when you start trading. For example, it's very important to avoid the fear and greed. It's very important to overcome the regret feeling, or if you want to, for example, if you have many losses, for example, try to avoid the market and basically try to avoid the overconfidence So basically, it's very important to take decisions based, for example, for technical analysis, fundamental analysis, based on a tested strategy. So basically, it's very recommended to try to avoid as much as you can your emotions, as it is expected to negatively affect your trading process. Now, we're going to discuss the risk management approaches. So basically, the position sizing is very important. It is recommended to never enter a trade that might lose more than, or that might incur more than 2% losses. It's very important to diversify your portfolio. For example, never enter a trade, for example, as we just mentioned, that you're going to lose more than 2% of your capital. The risk to reward ratio is very important. We're going to discuss it now. What do we mean by risk to reward? Always try to put or to place your take profit double or triple your stop loss amount. What do you mean by this? For example, here in our example, we have 10 trades. We lost 5 of them and we won 5 of them. So basically, if you apply a risk to reward ratio 3-to-1, it means that it is recommended to place your take profits 3 times your stop loss, or double the stop loss. For example, here we lost $1,000, but the second one, as we placed our take profit 3 times our stop loss, so basically here we have we gained 3,000, and here we lost 1,000. As you can see, the overall is that we won 15,000 and we lost 5,000. So basically, you can put the risk to reward ratio either 2-to-1, we mean to put your profits double your stop loss, and 3-to-1, which is the most recommended, which is try to put your take profit 3 times higher than the stop loss. Than the stop loss. So basically, it's very important to know your limits. For example, after losing a streak of maximum 3 trades, a trader should know his limit and call it that today is not my day, and try to avoid the market in this day. It's recommended to trust your decisions, as always remember that you entered a trade based on a tested strategy, based on a specific analysis, for example. So never question your decisions. You have to test them on the weekends, for example, at the end of the week. So basically, always trust your decision. And lastly, we're gonna talk about that you have to disconnect from happiness, sadness, and angry days. You also have to know that you will have bad days, for example, good days, and you'll have good weeks, good months. So basically, there's always an opportunities in the market. So never regret anything. So basically, we're going to discuss, for example, the services that we provide. We have a Telegram channel in Arabic and in English. We have a Trade Evolution CFI trading app. You can trade on MT4, MT5, C Trader. And we have a collaboration with TradingView. So basically, now you can link your CFI account with TradingView. You can follow our website. So basically, it's cfi.trade, in order to know our webinars, our reports. For example, when we have seminars, so basically we have educational webinars on weekly basis. We do a live analysis every Monday in English and Arabic. So it's very important to visit our website, cfi.trade, in order to see when is our webinars. Also, you can download tip ranks to follow the most important analysis, for example, for analysts in Wall Street. And lastly, you can also access Trading Central from your portal in order to have more analysis. It's a short-term analysis. So basically, you can also try to open your portal, and you can access Trading Central from there, as I just mentioned, for more analysis. Thank you all for watching, and looking forward to meet you in our next webinar. Thank you.
CFI. Empower yourself.